In this problem, we're going to prepare income statements under both absorption costing and variable costing. The following information relates to the second month of operations for Medical Research Corporation. The company had beginning inventory of 2,000 units and produced its normal capacity of 12,000 units and sold 13,000 units. Assume the production volume and the cost structure did not change over the 2-month period and there were no work-in-process inventories. Sales were $130,000. Your production costs were $48,000 for your variable costs and $12,000 for your fixed production costs. So remember, the variable production costs include direct material, direct labor, and variable overhead, and the only fixed production cost is fixed overhead. Total selling and administrative costs incurred were variable $18,000, fixed $6,000. We are going to compute income and value the finished goods inventory under both absorption and variable costing. So we're given this information, and what you will want to note is that all of the costs are given in total. None of the costs are given per unit. And so we are going to have to look at things a little bit differently in this problem. To be able to prepare the income statement or value ending finished goods inventory, we will need to compute the production cost per unit. And if you'll recall, under absorption costing, you will want to include all product costs. The variable production costs are $48,000. Those were incurred to produce 12,000 units. So the cost per unit is $4. The fixed production cost is $12,000. That will be distributed over the 12,000 units produced, giving us $1 per unit. The total production cost is $5 per unit. Now to prepare the income statement. We'll start with sales. They're given to be $130,000. Next, we subtract cost of goods sold, and we computed our cost per unit to be $5, and we sold 13,000 units. So the cost of goods sold is $65,000. Gross margin then is $65,000. Now we'll subtract our operating expenses. The variable selling and administrative expenses incurred totaled $18,000. The fixed selling and administrative expenses totaled $6,000. Notice that the operating expenses are expensed in full in the period incurred. It is not divided by production or sales to determine the amount. These are period costs. Our net operating income is $41,000. To value the ending inventory, we'll need to recall that we had beginning inventory of 2,000 units, we produced 12,000, and sold 13,000 units. We computed our production cost per unit to be $5. So first, determine the number of units that are included in ending inventory, and that would be 2,000 units plus 12,000 produced minus 13,000 sold, which gives us 1,000 units. Multiply that by the $5 per unit cost, and we have $5,000 that will appear on the balance sheet under ending finished goods inventory. Now we'll turn our focus to variable costing. Here we'll also need to find our cost per unit, and recall that under variable costing, the only costs assigned to inventory are your variable production cost of direct material, direct labor, and variable overhead. So we will take the $48,000, divide by the 12,000 units produced, and we get $4 per unit. Now we'll prepare the income statement. We'll start with sales of $130,000. We will subtract our variable costs. First, our variable cost of goods sold. We sold 13,000 units. Each one had a variable production cost of $4. That gives us variable cost of goods sold of $52,000. From here, all of our costs incurred will be expensed. So the variable selling cost of $18,000 will be expensed. That will give us a contribution margin of $60,000. We then subtract our fixed costs. We had fixed overhead incurred of $12,000, fixed selling and administrative expenses of $6,000, giving us income of $42,000. To value the ending finished goods inventory, remember that 1,000 units were left in inventory at the end of the period. The cost we determined was $4 per unit. So the value on the balance sheet for finished goods inventory will be $4,000.